You ever get that feeling like when the market's just on a tear, right? It's climbing, and it seems like everyone's making money. It feels like it'll never end.
Oh, yeah, totally.
It's intoxicating, isn't it? But then, well, things change. Reality kind of sets in. And that's what we're really getting into today, this fundamental idea that, what goes up
It's got to come down.
exactly must come down. But the interesting part is then it usually heads back up again.
That's the cycle.
It is. It's the cycle. And to understand it, we're tapping into Howard Marks and his book, Mastering the Market Cycle. The idea here is that, watching these cycles isn't just some theoretical thing. It's like actually crucial
For real.
if you want to, maybe even improve your chances of making good investment decisions. So think of this as like a crash course.
Love it.
In market cycles, getting to the heart of what Marx is saying, we're going to look at how these cycles work, but more importantly, how understanding them can give you an edge as an investor. And full transparency, all of this, everything we're talking about today, comes from Mark's book. We're diving deep into his ideas.
Makes sense. So where do we even begin with market cycles? What's the first thing people need to grasp?
Well, Marx makes this point that cycles aren't like anomalies. They're not weird glitches in the system. They're actually
Built in,
yeah, they're a fundamental part of how markets work.
like breathing. You inhale, you exhale, markets expand, they contract.
They like that analogy. And one of the big ideas he emphasizes is this concept of reversion to the mean. Basically, even if the market's growing over the long term, you're still going to see these shorter term cycles.
Ups and downs, swings back and forth.
Exactly. Things rarely just go straight up forever. There's always this ebb and flow around that average.
And those swings, they aren't random, they're connected.
Right. Each phase sets up the next one. It's this chain reaction driven by how investors, react and put their money to work.
Makes you think, like, is it the market driving investor behavior or is it the other way around?
That's a great question. It's probably a bit of both, this feedback loop. Now, something to keep in mind is that while the basic drivers, like too much optimism leading to prices getting inflated and then a correction.
Classic boom and bust.
Yeah, that tends to repeat across cycles. But each cycle is going to be a little different.
It's not a copy-paste situation.
Nope. The timing, how long each phase lasts, how fast things change, even what triggers those changes, it'll vary.
Every cycle has its own personality, I guess you could say.
I like that. But knowing the general anatomy, the common phases, still gives you a leg up. And a huge part of that is us, right? It's investor behavior, the psychology of the market.
So it's not just about the numbers, it's about the feelings behind the numbers.
Totally. It's like a pendulum swinging between, pessimism and optimism.
Fear and greed, the two big players.
Exactly. When times are good, everyone gets excited, right? Optimism builds and we can get carried away. Prices get too high, risk seems to disappear.
Until it doesn't.
Exactly. Something happens, sentiment shifts, and suddenly those inflated prices.
Pop goes the bottle.
And the thing is, these cycles often don't feel symmetrical.
Meaning?
Well, the climbs, the bull markets, they can feel gradual, like they're justified. But the drops, the bear markets, they feel sudden, brutal, even if the overall move isn't that different.
Yeah, it's the speed that gets you. Like 1 minute you're cruising along, next minute you're in free fall.
And that's the emotional impact. It's powerful.
So we know these cycles are natural, they're driven by our emotions, but what do they actually look like? What are the stages we should be watching for?
Marx outlines this 4-phase model. Starts with the upward phase. Things are looking up, economy's improving, companies are beating earnings estimates, exceeding expectations.
The good news cycle?
Right, and that positive news fuels more optimism. The media jumps on it, amplifies the sentiment.
Creates a feedback loop. More good news, more optimism, higher prices, rinse and repeat.
It's like a snowball effect, and expectations just keep rising. Investors start feeling really confident, like only good things are going to happen, right?
The this time is different syndrome.
Yeah, and capital becomes readily available, credit's flowing, asset prices are climbing, and people are more willing to take risks. Eventually, it can even lead to this sense of euphoria.
The peak, right?
Bingo, the peak. This is where caution goes out the window. Everyone thinks the good times will last forever, which ironically makes investors super vulnerable when prices finally do start to fall.
Because they're not prepared.
They're caught off guard. And that's the key insight. It's not just that markets go down, it's that the belief they'll only go up is what makes the fall so painful and creates that next opportunity. It's overconfidence that blinds us.
Powerful stuff. And that takes us to the downward phase, right? The flip side of the coin, what happens there?
Things start to unravel. Economic fundamentals weaken, companies miss earnings targets, the media starts focusing on the negative.
The bad news cycle kicks in.
Exactly. Pessimism spreads, expectations fall, confidence erodes, prices drop, and risk aversion takes over. Everyone wants to play it safe.
And that selling can feed on itself, right? Lower prices, more fear, more selling, and the cycle continues.
It can feel like a downward spiral, but eventually this pressure leads us to the bottom, the trough.
What does that look like?
Well, asset prices are at their lowest, and importantly, perceived risk is very high. Everyone's scared.
Seems like the worst time to buy, right?
Counterintuitively, it can actually be the best time. Marx argues that this is when you should start thinking about being aggressive, about buying.
Buying when everyone else is selling, that's going against the grain.
Exactly, because from that low point, as some brave investors start seeing potential for recovery, they start buying, and that can kickstart the next upward cycle.
So the classic advice, buy low, sell high, actually has some merit.
It does, and as we've been saying, this whole cycle is heavily influenced by how investors feel, their collective psychology. Let's dig into that a little more.
Okay, so it's not just about cold, hard numbers. It's about the emotions driving those numbers. You mentioned extreme optimism and pessimism. How do those play out in the market?
Well, think about peak optimism. It's this widespread conviction that the good times will just roll on forever, a tendency to ignore warning signs, and this feeling that this time is different. The old rules don't apply anymore.
The new paradigm thinking.
Exactly. But then on the other side, in the depths of pessimism, it's like this sense of hopelessness, this belief that things will never get better.
Yeah, like it's the end of the world.
And people are hesitant to see any potential for improvement. Marx points out this crucial factor that makes these emotional swings even stronger, our inability to really remember the past.
What do you mean?
Well, we might know intellectually that markets are cyclical, but when we're in the middle of it, caught up in the excitement of a boom or the fear of a bust,
It's hard to keep that big picture in mind.
we forget what happened in previous cycles. Our memory's selective, recent experiences have a bigger impact on our decisions than those from long ago.
So this lack of historical perspective makes the highs higher and the lows lower.
It does. And then there's the whole issue of risk perception. How do you think that changes throughout the cycle?
Well, my guess is that when things are going great, everyone feels like there's no risk, right? Like nothing can go wrong.
You nailed it. At the peak of a bull market, perceived risk is at its lowest, even though asset prices are high and the real underlying risk is probably the greatest.
It's like that saying, the greatest source of risk is the belief that there is no risk.
Marx says that exactly. And that complacency, that comfort with risk, is often what sets the stage for the correction that follows.
It's like a house of cards waiting for a gust of wind.
Perfect analogy. And then, of course, there's the opposite scenario, the trough of a bear market. Prices are down, potential for gains is high, but perceived risk feels huge.
So it's almost like a paradox. When things seem safest, they might actually be most dangerous, and when they seem most dangerous, that might be the best time to buy.
It is a bit of a paradox, and Marx makes this really interesting point about overvaluation. It tends to happen near the peak. Prices get detached from their real value, fueled by that excessive optimism and
Easy money.
yes, easy money. Credit's readily available, it keeps the economy going, but it can also inflate those asset prices to unsustainable levels.
And then on the flip side, you have undervaluation, which happens during downturns when everyone's panicking and selling, regardless of what the assets are actually worth.
And the tightening of credit during those times just makes things worse.
So it's like this constant push and pull between fear and greed, between overvaluation and undervaluation.
It is, and it's all happening within the context of the broader economy, right? The economic or business cycle is the foundation for these market cycles.
So when the economy's expanding, businesses are doing well, profits are up, and the stock market tends to rise.
Right. But Marx says it's crucial to focus on long-term economic trends, not just the short-term ups and downs.
Yeah, the long game is key.
The short-term cycles, the ones that get all the attention, are really just fluctuations around those longer-term trends. The waves on the ocean versus the tide, right?
Love that analogy. It's the tide that really matters in the long run.
Exactly. And extreme swings in the economic cycle, they're not ideal.
Too much growth can lead to inflation. Too much slowing can hurt companies and jobs.
And that's where governments and central banks try to step in, smooth things out a bit.
But it's not a perfect science.
No, it's not. And remember, different sectors of the economy react differently to these changes.
Some are more sensitive than others.
That's because of things like operating and financial leverage. Leverage means using borrowed money. Companies with high financial leverage, they have a lot of debt.
Debt can be a double-edged sword.
It is. When times are good, it magnifies their returns. But when times are bad, it magnifies their losses.
Like a high-risk, high-reward kind of thing.
Exactly. And operating leverage has to do with how much of a company's costs are fixed. Companies with high operating leverage, they see bigger swings in their profits as sales go up and down.
Makes sense. So, like, companies that produce raw materials, they might be more affected by the economic cycle than companies that sell everyday necessities, right?
You got it. Understanding this helps investors figure out which companies might do better or worse in different phases of the cycle. And all of this ties back to investor psychology, to those behavioral biases we've talked about.
Herding mentality and all that.
Exactly. Marx doesn't go into specific biases in detail, but he does talk about how the crowd is often wrong at the extremes.
Meaning when everyone's super bullish, that might be the time to be cautious, and when everyone's super bearish, that might be the time to look for opportunities.
You got it. It's about being contrarian, going against the crowd, which can be a very powerful strategy.
So with all this talk about cycles, the big question is, how do we time the market? Is that even possible?
Marx is pretty upfront about this. He says consistently timing market peaks and troughs is incredibly difficult.
Borderline impossible, right?
Pretty much. Instead of trying to be perfect timers, we should focus on the long term and just try to understand where we are in the cycle.
Like get a general sense of the bigger picture.
Exactly. Short-term market movements, they're often just noise.
Distractions from the main event.
And Marx talks about these 3 stages of a bull market, which I found really helpful. The first stage is all about skepticism.
People are still shell-shocked from the last downturn?
Right. Only a few investors believe things are actually going to improve. Lots of negativity, lots of doubt.
It's the show me phase, like prove to me that things are really getting better.
Then comes stage 2. More investors start to see the evidence of recovery.
The momentum builds.
Sentiment shifts from cautious optimism to a more widespread belief that things are on the upswing.
And that leads to stage 2, where everyone's convinced the party will never end.
The euphoria stage.
The "this time is different" mantra comes back with a vengeance.
And you often see excessive risk-taking, inflated asset prices.
The bubble is inflating.
Understanding these stages can help you think about how to position your investments.
Like maybe be more invested during stages 1 and 2, and then become more cautious as we move into stage 3.
Exactly. And through all of this, patience is key. Those longer-term trends, they only become clear over time.
The slow and steady wins the race kind of thing.
It does. So if timing the market perfectly is so hard, what about risk management? How do we navigate this cyclical environment safely?
Well, Marx talks about portfolio positioning and asset selection as our main tools.
Our levers to control risk.
He breaks it down into 3 key pairings: skill and luck, cycle positioning and asset selection, and aggressiveness versus defensiveness.
So while we can't control luck, we can definitely work on the other factors.
And cycle positioning, as we've discussed, is all about trying to own more of an asset when it's cheap and less when it's expensive.
It's about adjusting your portfolio's aggressiveness based on where you think the market is in the cycle.
It's being a contrarian, doing what feels uncomfortable, going against the crowd.
And while we haven't talked a ton about interest rates and inflation, they definitely play a role.
Oh, for sure. Marx doesn't spend a ton of time on it in this summary, but the availability of credit, which he says is crucial for the economy, is directly tied to interest rates.
Right. Lower rates mean cheaper borrowing, more credit flowing, which can boost the economy, but also potentially lead to asset price inflation.
Too much of a good thing.
And then there's inflation. Marx mentions it briefly with real estate, the idea that people buy real estate to hedge against inflation.
But if you buy it when it's already overpriced, it might not be such a great hedge.
Exactly. So keeping an eye on interest rates and inflation can give you clues about where we might be in the cycle and what might happen next.
So finally, how can investors actually make money in these different market phases?
It comes back to adjusting your aggressiveness based on the cycle, like we talked about with the 3 stages of a bull market.
But what about downturns? Are there opportunities to be found there too?
Definitely. Marx uses the example of a distressed debt investor. These investors buy debt of companies that are struggling, often at a steep discount, betting that the company will turn around or that they can recover some value.
That takes guts.
It does. It's that contrarian mindset again, seeing value where others see only risk.
It all comes back to being fearful when others are greedy and greedy when others are fearful.
That's the key takeaway. Understanding market cycles isn't about predicting the future perfectly. It's about improving your odds by recognizing patterns, getting a sense of what might happen next, and being disciplined about price.
It's about making informed decisions, not emotional ones.
Exactly. So as we wrap up, think about this. Market cycles have always been around. They're probably going to keep happening as long as human psychology drives markets.
We're emotional creatures.
We are, and that tendency towards excess, towards getting carried away, it seems pretty ingrained in us. So where do you think we are in the current cycle? That's something worth pondering.
Food for thought, for sure.
Absolutely.
Until next time.
See you then.